So if you guys saw my last video, then you'll know that I sold out of Warner Brothers Discovery, the spin-off company from AT&T, and I have officially reinvested those funds and added a new position to my dividend stock portfolio. I told myself I wasn't going to do it, but I saw an opportunity, so I went with it and I added Lowe's, ticker symbol LOW, and in this video, I'm going to explain why and share some of the things that stuck out to me about this company. So without further ado, let's get into it. All right, my friends, what is going on? It's so great to see you guys. My name is Ryan Williams, and here I show you how to create passive income and reach financial freedom by investing in dividend stocks. And like I said just a moment ago, I added Lowe's to my dividend stock portfolio, which is a stock that has been sitting on my watch list since at least last July. And actually looking at this clip right here has got me thinking I should have just added it then. It was cheaper then than it is today. And having said that, I want to start off by addressing this company's valuation, which is one of the reasons I decided to finally pull the trigger on it. And to discuss that a little bit more, let's jump over to the screen. All right, guys, so we are here looking at my dividend stock portfolio on Charles Schwab, which is the brokerage that I use to buy and sell dividend stocks. And if you saw my last video, you'll know that from the sale of Warner Brothers Discovery, ticker symbol WBD, I had about $580 to reinvest back into this portfolio. And I put all of that into Lowe's, actually. If we go over to this gain and loss page and scroll down, you guys can see that that $580 bought me 2.87 shares of Lowe's at an average cost per share of $203.97. And at this point in time, I'm officially down 1.32%. It's all good though, guys. I'm actually happy to see it coming down in share price, which is something that Lowe's has been doing a lot of lately. And if we go over to Seeking Alpha, taking a deeper look at this company's share price performance, you can see from this price chart right here that Lowe's is making its way down. It is really coming down in share price. In the last year, it's down just a hair, 0.12%. But in the last 6 months, it's down 7%. And Seeking Alpha won't show us this on the mobile app, but if you were to go on the computer, on a desktop and look it up, you'll see that Lowe's is down over 20% year to date. So it's really been coming down in share price lately. Now, although year to date, Lowe's has really come down a lot in share price, guys, if we zoom out to this 5-year chart, we can see that it's done more appreciating than anything. It has really climbed in share price. And prior to 2020, when all the craziness started, this company was sitting at about $110, $115 per share, got up to $120 per share, and then really sunk during the pandemic to like probably under $70 per share at some point. But since then, obviously, it's really come up. And so having said that, although Lowe's is down 20% year to date, it still has a lot more room to come down, which is something we might see happen if we were to enter into some sort of a recession, which has been a topic of speculation lately. You'll see headlines all over the place talking about this, especially now that interest rates are on their way up, which directly impacts Lowe's as a company, because Lowe's has benefited quite a bit over the last couple years from the pandemic. A lot more people at home, a lot more people working on fixing up their houses, really prioritizing on making that space nice, because the home for many people was used for a handful of different things. Not only a place to live, but it became an office, it became a school, it became just a place to play. And with rising interest rates and the real estate market potentially changing, this could have an impact on Lowe's. We'll just have to see what happens. But at any rate, guys, considering that Lowe's still has a lot more room to come down, it begs the question, why did I buy now? Why didn't I just wait for it to keep getting cheaper before pulling the trigger? Because it seems to be heading in that direction anyway. And truth be told, although it has been going down lately, there's no telling what the share price is going to do. Every day on the stock market is different. And because of that, I didn't want to try and time the market. I just wanted to get this cash to work right away. I plan to hold this company for a long, long time, and ultimately will come to have probably thousands and thousands of dollars invested into Lowe's over the course of the next handful of decades. So this initial $580 investment shouldn't derail the possibility of getting a good return in the future. And actually, having said that, I think the share price is still looking pretty good. I think Lowe's is at a pretty good value right now. As you guys can see, Lowe's has a forward PE ratio of 14.96, which for a company like this, anything under 20 is enticing. Sub 20, we could look at this and say, okay, this might be worth a deeper dive because it's not looking to be too bad right now. But we can see the forward PE ratio is 20.75% higher than the sector median. So across some of the other companies in the consumer discretionary sector, Lowe's is a little bit more expensive. But scrolling over over a little bit more. Compared to this company's historical record, its 5-year average, it is considerably cheaper by nearly 20%. And that's just one metric we can use to try and identify how affordably valued a company is. It's a really great starting point. Another metric that we can do, or another calculation we can make, is a discounted cash flow calculation. And as you can see on the screen, I did this for Lowe's. And for those of you who are not quite familiar with discounted cash flow calculations, essentially what this does is it helps us determine a tangible fair value or intrinsic value for the company we're looking at based on its expected cash flow returns in the future. So upon doing this for Lowe's, using an 8% margin of safety, which essentially gives us a cushion in case, any of our assumptions or our calculation was wrong. It's a nice cushion. We get a fair value of $200.39, which is right about where it's at today. It's $201.28 at the time of this recording. So right about there. Now, furthermore, if we reduced our margin of safety, gave ourselves a little bit less cushion, and instead of an 8% required return, we use 7.5%, we can see that Lowe's is actually pretty undervalued by 11.77%. So based on my understanding of the valuation, taking a look at these two things, I feel pretty good about buying Lowe's today at its current share price, and I feel pretty confident that I'll be able to generate a decent return with this stock in the future, especially if we're talking over the course of the next handful of decades. After all, guys, this is a long-term game. Don't forget that. And moving on, one of the other things I really liked about Lowe's as I was doing my research is the financials. I think this company is pretty financially sound. We're not going to go through the income statement and the balance sheet and the statement of cash flows. We're not going to go super deep into it, but what we will do is we're going to go over to this growth page right here and just take a look at a high-level overview of all of these metrics. So scrolling down, guys, we can see just as far as revenue goes, its top line, its sales, it's doing pretty good. Year over year, they saw 7.4% gain, compounded across the last 3 years, 10.5%. Double digits is nice. Compounded across the last 5 years, a growth of 8% in revenue. And then across the last 10 years, they have a compound annual growth rate of 6.72%. So all across the board, we're seeing steady revenue growth, which means that this company is continuing to increase sales, acquire more customers, and even, create returning customers. Furthermore, we can look at the net income and the levered free cash flow, which is what we call the bottom line. This is the money that's left over after all expenses and stuff are paid out. It seems that they're becoming a more profitable company as the years go on. Now, year over year, the levered free cash flow is down 17.5%. But if we zoom out across a longer period of time, compounded across the last 10 years, we can see that the levered free cash flow has grown 11.96% year over year across the last 10 years. That's just the compound annual growth rate, which obviously is higher than what we're seeing with the revenue, which means that although sales are increasing, profitability and the cash left over at the end of the day is increasing at an even quicker rate. To put it simply, this is great for us shareholders because this indicates that we could be due for some continued dividend growth and also possibly some more share buybacks. Which on that note, Lowe's is doing a great job already of buying back shares. As we can see from this chart here, you can see the shares outstanding going down over time. And from their latest earnings release, they shared that the company repurchased approximately 16 million shares for $4 billion in the fourth quarter of, it'd be 2021, and it repurchased 63 million shares for $13.1 billion for the entire year. Total share repurchases in 2021 were 1.1 billion, higher than anticipated, which is awesome, reflecting better than expected financial performance and the company's commitment to return excess capital to shareholders. That's a whole lot of good news right there. And regarding the dividends, they say the company also paid $551 million in dividends in the fourth quarter and $2 billion in dividends for the entire year. In total, the company returned $15.1 billion to shareholders through share repurchases and dividends in 2021. And this leads us to the next point, guys, is talking about the dividends. Now, there are a few things that I really like about Lowe's dividend. The dividend yield not necessarily being one of them. The yield is 1.59%, which is pretty low and is exceptionally low compared to my portfolio's overall dividend yield, which is probably at about 4.5%. So definitely getting a lower dividend yield, but the rest of the dividend metrics look just outstanding. They have a payout ratio, a very low payout ratio of 25%, which means that they're paying out 25% of their leftover free cash flow to the dividend and just doing other things with the rest. Maybe they're holding on to it. Maybe they're using that to buy back more shares. But at any rate, they're not using a lot of the free cash flow to pay the dividend, which is good and speaks to the security of the dividend, I think, and could indicate that the dividend's not really financially stressing this company out at all, which could mean it's likely to continue growing and continue being paid as time goes on. Now, moving on to the next metric, I know that was a mouthful, I'm sorry. The 5-year growth rate is also very high, 17.67%. And I'll tell you what, this is exactly what I'm looking for in dividend stocks right now. I have a lot of high yielders in my portfolio, like AT&T AT&T, EPD, Altria Group, ORCC, XYLD. The list goes on and on. I need some more dividend growth. I need some more companies like this who are going to grow their dividend as time goes on, and Lowe's is the perfect example of that. Very high 5-year growth rate, and they have a very, very impressive dividend growth history to match. They have 58 consecutive years of dividend growth, making Lowe's a dividend king, which is never a bad thing to have in your portfolio. You can never have too many dividend kings, in my opinion. Now, regarding my plan with this stock, guys, I'm going to be adding it to my weekly buy list. I will be contributing more money to this position every single week and swooping up more shares to really try and build out this position and make it a sizable amount of my portfolio while it's becoming cheaper. In addition to this, I'm also going to continue adding to some of the other stocks I've been buying lately, like Starbucks, Snap-on, Intel. I'll probably rotate those 3 in my weekly buy list along with Lowe's, but Lowe's will be a staple for sure. I see Starbucks being a staple for now as well because it's also very cheap. And I'll definitely continue adding to Snap-on because I'm not quite where I want to be with that position yet. So hopefully all of this makes sense, and I'd be very curious to hear your guys' thoughts on Lowe's in the comments below. At any rate, if you want to keep the party going and keep talking dividend stocks with me, then click on this video right up over here. And also, if you want to see more videos from me in the future and stay up to date with me, then hit the subscribe button right here. And with that, guys, thank you so much for watching this video. I really appreciate it. Hope you all have a great day, and I will see you in the next one.